Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about why mortgage rates didn't go lower after the big Fed rate cut. Logan, welcome back to the podcast on this momentous day after we had to take a one-day lag time here on the Fed's big announcement.
I'm holding up the cup. Labor over inflation. Well, we had a crazy day yesterday, Fed day. We get a call from CNBC. Can you come on air in an hour? We're like trying to figure out how can we do the podcast, how we do see our flights and everything. So we couldn't do a lot of stuff yesterday, but we're here today. And I'm going to start by going over one thing because there's people out there who said, why did mortgage rates go up? Right? This is Thursday morning. The 10-year yield right now is 3.75. So just for a second, forget that the Fed cut rates by half a basis point. Okay, just throw that away. The 10-year yield broke that hoarder line, right? Hold the door, right? We had jobs a week. 3 of the 4 labor reports were under expectation. We broke down all the way to 3. I mean, we were getting closer to Gandalf, right? Gandalf needs, the labor market breaking. Labor market's getting softer, not breaking yet. So what happened at 5:30 in the morning that shot the 10-year yield up? Housing starts. Housing starts beat. Single family permits are rising. Single family permits rising is a very strong economic expansion indicator, right? It had been falling all year. So industrial production data was good yesterday. Today, jobless claims fell again, right? Everything that on the economic side was positive, so yields went up. If the Fed didn't cut rates or weren't part of the question, none of us would be having any kind of discussion about this. But I think what happened is that people saw the 50-50 cut and they thought, oh my God, that's bigger. So the Fed is old and slow, but the bond market isn't. So we're way ahead of the Fed. So we had this I think 4 podcasts ago where you said, Logan, rate cuts. Like, no, it's not rate cuts. Rate cuts are good for the spreads. It's good for maybe anchoring expectations about rates ever going up, but the 10-year yield is already at really key levels. It's already, priced in so much. So if you look at it in that light, then the 10-year yield rising from 360 to 372 and then up, I think the high of this morning was almost about 377 makes sense because we're already so much lower than where we were. And if housing starts came in as a miss, which would have been a surprise, if industrial production was negative, if jobless claims had ticked up, we're having a different conversation because the economic data and the labor data was getting weaker. So you got legs to grow if you want to, but now that we're here at 360, we're saying, yo, look, it's Gandalf. I can see him. It's a whole different conversation now than, the 10-year yield, whatever, at 470. We need confidence. Sarah. We need confidence that inflation is getting to 2% before we do anything. Bond market's like, see you, homie. Goodbye. Ha ha. Right. So hopefully that explains this in a way that maybe nobody else is talking about it because, there were some people that are confused.
No, I think people are very confused. I know we saw on social, and I know you've had people reach out, tons of people who are like either agents or they're loan officers, and people are calling saying, okay, can I get a lower rate now? Oh, okay. So this must mean that, my rate just went down by 0.5%. It's like, that's not the way it works. And so I think this is a really good conversation so that our listeners can explain to their clients why that's not true.
If you had just listened to HousingWire's podcast, which we're so close to getting our 1 million download this year.
Yes, we are.
You would have known the slow dance, right? That slow dance between the 10-year yield and 30-year mortgage rate. The reason I say it that way so people can realize the bond market gets ahead of the Fed, right? So in 2023, when the 10-year yield was at 5%, the bond market made this huge rally, sending yield lower, mortgage rates were lower because the market officially believed back then the Fed was done hiking rates. And then we had this Mickey Mouse dance early on in the year. And so it's just one of those things that people, this slow dance was created to show you that the economic data is really, we're going to be running the show. And if things were weaker, then we would have seen yields not get up to these levels today. But the Fed cut 50 basis points. It wasn't like he was extremely dovish. He was like, we're still restrictive, and the economy isn't breaking, so we're just cutting because the labor market was getting soft on them. So
Right.
I actually can give you the reason I believe that they went 50 and they're a little bit more mindful. Would you like to hear it, Sarah?
I would love to hear it. Yes.
We're all data miners, right? All of us we believe in models. We say YouTube is trash, Twitter is trash, Instagram is trash, TikTok is trash, because these are not people who model anything. They just constantly do doom porn until the end. So there's no checks and balances. They're going to sound completely negative until death, and not even the devil will accept them in the pits of hell. They will go somewhere lower. But if you have models and you're looking at economic cycles, this is just my theory, and all of a sudden you have the housing market start to get really weaker when the labor deterioration is happening, then you're like, oh my God, we pay these people to do what? They're not giving us proper models, right? The Fed says, well, old models aren't working, so we pick up the phone. Oh, are you firing anyone? Oh, you're not? Okay. Oh, confidence. All of a sudden, labor data is getting soft with the internals, right? If you guys could watch that Fed presser with Powell, what did he talk about? Job openings, quits, hires, layoffs, things that we've been talking, is this is what the Fed tracks. So you don't have any leeway or anything like that. So what's occurred this year that's different than 2022 and 2023? Remember, the Fed doesn't care about the existing home sales market. It's all is about new home sales and housing starts. Permits were falling, single family permits. Multifamily permits were already at recession levels, but then Home Depot and Lowe's warned. Okay, so residential remodeling construction workers is a big part of that. It's also a part of GDP, right? So you have now a function of investments and now labor all going against each other in one direction, and rates were heading higher. So if the Federal Reserve paid someone to do this analysis for you, staffers, guess what? You're playing with fire you don't need to. So
Yeah.
the 10-year yield had gone lower, mortgage rates gone lower, the builder's confidence picked up, new home sales beat, voila, single families picked up, permits did, housing starts picked up. We're working from a very low level now compared to the peak, so you have to keep this going. So going 50 and trying to anchor rates to stay lower, not go back up there again. Right? The only people that want rates to go up are the people that have been calling for a recession, and they've been wrong, and it's just not working out. Right? I see these clowns everywhere every day. Inflation's going to go back. Arthur Burrs and every. It's one group of people, just one. Okay,
So
so that's why I believe that there's a little bit more. Okay, let's just kind of get down to neutral. Let's keep. We don't. If they have rates go against them, they've seen what happens to the housing construction data. Because once you lose that, then it looks like every single recession we've had. And if they tell you we don't see a recession, and that happens, oh boy, that means all of them failed, fired, because they are no longer the bastion of economic data. There are thousands of data miners out there that don't work for the government, Federal Reserve, who look in this stuff and thinking, you're getting close there, homie. You really want to push this. So positive, 50 cut, positive. But again, anchoring this stuff to go down and not have it reaccelerate up, it's probably good for them at this point.
So let's look at it another way. Let's talk about the recession. If we have avoided that, this is the soft landing we were hoping for.
Yes, because if you think about the soft landing, right, and the soft landing was based on, can the Federal Reserve land the plane without breaking the labor market and jobless claims going up and unemployment going up. So I understand everybody is sitting there, everybody in the mortgage and real estate industry, the economy is terrible. You want rates to go. I get that. But you can't have, if jobless claims aren't breaking, then it's not, we can't sit here for the next 10 years and say, is this a soft landing or a hard landing? No. We're going into 2025. We can't even have this conversation anymore. We have to talk about this like traditional economic cycles. You can't just sit here and say soft and hard landing. So I think that if I was a Fed, I'd just we just want to keep the economy expanding and keep on and anchor the rates to go lower to prevent that last phase, because we've highlighted this time and time again. Traditionally, what happens before recession, residential construction workers lose their jobs, and then the economy goes into recession. Imagine if that was the case right now. If we started to see unemployment rates pick up for construction workers, you're north of 5%. That means all this talk the Fed did was wrong. So I am hoping that this was the case. I'm hoping they saw the data and they go, boy, we're really pushing this, because the last jobs report actually had a decline in manufacturing jobs. Traditionally, manufacturing and construction workers lose their jobs. And in that context, it's recessionary at the point. They don't have any more leeway anymore on that. So now that, some of the data became really good and the 10-year yield has already fallen down, hopefully that explains why rates are up just a little bit. Nothing bad, nothing crazy, but around 370 to 380, this looks about right? Because we're just trying to keep this expansion going out there. And the spreads were really good today. Like today was the best day of spreads, in a long time. And it does make such a huge difference. I mean, I'm calculating some of this stuff at 75 to 85 basis points lower on the worst, like I'm talking the really worst days of the spreads, and on days that the 10-year yield is higher. So it did make a difference this year for the housing market.
So, spreads are one thing. In the tracker article, or maybe last time we talked when we were giving, like here's the preview of the Fed day, you talked about what could drive rates lower, because, this is just really tricky. Now you have consumers who are like, they've been super paying attention to the fact that rates go down. They don't really know what that means. They think that, oh, the Fed lowered rates, that means I should get this different rate. So can you talk about when rates might go even lower than they are now? I mean, because we talked about some of those factors and what we should look for.
So why should rates go any lower right now? Why should it? Like,
Because I want
why
them
should
to.
it? Why, if the economy is not going into recession, why
Right.
shouldn't rates go up? Ask that question, and then all of a sudden you're like, well, the spreads. Okay, so there's a few things that can make mortgage rates go lower. Number one, the spreads, which is already happening. Spreads have already we've made enough progress on the spreads where it's material. So that could still get better. We don't have as much leeway anymore like we did at the start of the year, but there's still a little bit ways to go. If the economic data gets worse, then the 10-year yield can keep on going lower and mortgage rates can follow it. But that needs the labor data to get weaker, economic growth to get weaker. And remember, housing is part of residential GDP construction, right? All these things go into the growth aspect. And then third, if the Fed starts to get more dovish, where the language, right? So it's by Friday morning, I think Harker's the only Fed president that has a speech. What are they saying now in the Fed speeches? Those things, but we've already had a big move. I know there's a narrative out there that, well, people are just assuming that their rates are going to go lower. Listen, there's a traditional seasonality curve in purchase apps, right? People just don't go all of a sudden, okay, I wasn't thinking about buying a house, but I see rates are down. No. So there's a flow of human beings living that say, okay, I'm ready. We're thinking about home buying. Okay, so we're just waiting for the rates to go lower because we've already pre-qualified ourselves, because that's what normal people do. And then they pull the trigger. So as we get toward November, December, and January, then we start to see the seasonal volume push. That's where more people actually traditionally come in. So I know there's a lot of people that say, well, some people are just waiting for lower rates. Listen, if some people really need low rates, they don't qualify. Or if some people do need low rates, that comfort level. but we have seen a material change in the purchase application data. So again, last 15 weeks, the best 15 weeks in purchase apps, 10 positive, 5 negative. That's a 2-to-1 spread. The volume curve isn't very high, but previously we had 14 negative, 2 positive, 2 flats. There's a change, right? The question is, what kind of volumes are you looking for? I don't see like you could have big volume growth until you get sub 6%, because that's what the builders are showing. The builders have milked this like perfectly, because they have the gross profit margins to do this. So they're doing, and this is why they're growing sales since 2022. But the existing home sales market has not had a viable sub 6% mortgage market to work with. And they asked some housing questions specifically to the Federal Reserve, which is so painfully bad. Sarah, do you want to know how bad they are?
How bad?
They're like, I forgot the reporter. It's like, well, what if home prices go up again and inflation takes off? Home prices are not part of the CPI inflation data, nor is it the PCE. And we highlight this because during the housing bubble years, during the housing bubble credit years, prices were escalating out of control. Credit was that. Inflation didn't look anything out of the ordinary. I encourage everyone, I implore everyone, go back. Oh my God, none of you will do this, but go
None of
back
us
and
will
look at
do
the
that.
CPI inflation report, the PCE, and look at during 2002 to 5. Nothing, right? This was a global pandemic. So Powell, I thought, answered it poorly because he says the same thing. They're not really housing people. That's the thing. Powell's really not a housing person. He says, well, people have very low rates. They don't want to sell or give up their rates. Guy, they just don't qualify, guys, because millions of people are buying homes still. We're going to have near 5 million total home sales this year, like we did last year. So there are people there. When they qualify and it's good, they go. They've so many people have sold their 2, 3, 4% rates to get rates in the 6.5, 7.5, even 8s. If you qualify and you need to move, you do it. But in this case, when the person asks, well, what if home prices rise? You know what Powell should have said? This is this is how I'd answer this. Well, everyone in America, the history of home prices rising is pretty good. Sometimes it's really fast, not good. And sometimes it's very low, which is good. But if I take 2007 and 11, and the reporter kind of said, well, people are frustrated. They thought home prices would fall or something to that nature. And it's like, we only had one period that this happened, 2007 to 11, and that was a deflationary credit boost, foreclosures. Oh, you're not getting that. Hello,
Right.
McFly. There's nothing here. You're not getting national home prices to crash again and all that stuff. He doesn't do this. So it leaves an interpretation. And then some of them, like Waller back in the days, oh, well, we think home prices should fall 10 to 15%. So if you say it in that way, our policy is not to have a foreclosure crisis, recession again, and people lose homes just because a bunch of crybabies out there say, why aren't home prices crashing? I was told home. Listen, you listen to idiots on YouTube. This is what happens, right? I don't think there's a swath of people in America that listen to these crazy kids and, oh man, are they crazy? And think, I'm not buying a home for 10, 12, 13 years because this guy on YouTube said home prices are going to crash. No, I just think there's a natural flow of buyers and sellers. When affordability gets worse, you don't have that kind of transaction volume. So the curve looks normal. And a good way to think about this is, because this is how I think the Fed thinks about this. In the previous decade, the peak of total home sales, roughly around 6 million, we're roughly almost around 5 million. They see that as the housing market, if the majority of home buyers are still intact, but the marginal home buyers are killed. So if you look at it in that light, you can see why they don't really care too much about the existing home sales market, but the new home sales market, yes. Residential construction workers, yes.
Okay, so, given that we had good economic data the last couple of days, does that mean that we're pretty much where we're going to be for mortgage rates?
I that
Not only just for the 10-year yield, but also for the Fed funds rate. I mean, is he
I
going to?
this is my what I've been talking about for the last 3 weeks. We are getting close to the bottom end of the forecast. Now, can my forecast be wrong? Yeah, because I had a 7.25 peak and we got to 7.5. right? So we can have situations where rates go lower. But for this year, we're already kind of at the bottom. So unless I see spreads get better, the Feds get dovish, or weaker economic data, this is kind of it. That's why we do forecasts. That's why we do models. That's why we track data to see if we're right or wrong. We don't make up stuff and just like, oh, I was wrong for 6 years, but I'm not gonna recalibrate myself or look back at my model, because most people don't have models. So this way we could talk about the data. Like today, I could explain to you why mortgage rates went up, because look at the data: start speed, industrial production, jobless claims, right? So the mortgage rates went up just a little bit off of that because the spreads are better. So this is as good as you can get, considering all the factors. But again, the Fed, their rate cuts, they're so behind what the market is priced in. Like if I had a 2-year yield chart right here, the 2-year yield's like all the way down here. They go, yo, homie, we're down here. What are you doing? I think the economy's fine. We're going to take it slow. So that's the thing, is that the whole slow dance, right? This whole premise of touring around the country and doing the slow dance and trying to explain is that what drives the 10-year yield drives mortgage rates. Sometimes we're close. Sometimes we're far away. That's the spreads, right? When I say we're close, the spreads are getting better. So the slow dance gets a little bit more intimate, right? The spreads, give me a knife, give me a piece of bread, and let me get peanut butter and jelly, and the spreads are looking great. And that's really helping this year. Last year, that wasn't the case.
Yeah.
So hopefully this explains that. Forget about the Fed rate cuts. Think about the economic data. What we've always said is we think about the economic data, the labor data. That's what's really driving. The Fed cutting rates, good, positive. Spreads could get better. They could anchor rates to go stay lower, not spike up like they did. But when they were doing their, we need confidence. We need confidence. Okay, all right, 10-year yield kept on going higher and higher. Well, the economic data was beating, but the internals were getting weaker. So hopefully, this is why I love that 50 cut, because I think they're finally getting, boy, we are playing with fire. We don't want to, but let's like flame on. Deadpool and Wolverine. It wasn't Captain America. So
you had said you thought it was going to be 25 because
25 and a dovish statement. And now that I think about it in that light, like some people are trying to say it's a hawkish 50 basis point. You really have a hawkish 50 basis point. I believe that looking at all the latest labor data, if they can go back in time, they probably would have done a quarter before the 2 meetings ago and just do a quarter now. But I'm trying to get a sense of, Powell isn't saying, oh, the economy's breaking. It's just, it's so hard for him to talk about this is back-to-back conferences where he doesn't look sure, he doesn't look good, right? He's trying to say, well, we think the labor market is getting, there's risk there, but the labor market's fine. So see, we knew this would happen, right? It's just that they kept it because they needed the labor market to get to the point to where they feel confidence that they could cut rates, right? I mean, I think there's just a few people left that are saying, yo, you shouldn't have cut rates, or you should, but we get into this, well, jobless claims are low. Why are you cutting rates? We don't wait for jobless claims to break. Everyone, by the time jobless claims break, it's over. Right? You got to get ahead of the curve. And I think there's where they're kind of, okay. Housing starts were down, permits were down. Home Depot warned, we're playing with fire. And that's why the housing starts report this week was probably the bigger thing than the Fed cuts, because the one data line that was breaking on that, and I'm just assuming, I'm giving them a lot of credit, that their analysts, their economists, hopefully just looked at all the economic data that we've seen since the Peloponnesian War and said, Jay, this doesn't look good. Permits are at recession level, starts at recession, and now Home Depot and Lowe's warned. So I think we've pushed the limit here. That's what I'm hoping occurred. That's my theory with them. And now it gets more interesting, more fun. And you all need, kind of a new Jack economist for a new Jack economy, and how to talk about economic data and the 10-year yield and spreads and everything. and not listen to those crazy people or not listen to Wall Street or anything. I could explain this. I have no life. I literally look at this stuff 24/7. I don't sleep or anything, but you're going to have the faith that I'm not here to push or pull your strings or whatever. I'm here to just relay the market data. And those are how models work. And we explained it this way so we could understand why mortgage rates went up a little bit after the Fed rate cut.
Last thing to ask you about existing home sales.
Oh, okay. So existing home sales came in a light compared to some estimates. And of course, remember, purchase application data, we had that first little wave good, and then little dip there. The last few weeks have been positive, and this looks out 30 to 90 days. We're kind of underneath that 4 million level. It's again, now that we're at 2024, now that rates have fallen from 8%, do you see how rare it is to like get below 4 million and blow down much higher? No, because there's that core buyer, that core 4 million buyers there. So sometimes we're above 4 million, under 4 million. But the next few weeks, purchase application data almost had its first positive year-over-year print. We have some very, very low comps now going out because this last year we're heading toward 8% in October. So we're probably going to see some positive year-over-year prints. Just take that into context. Follow our podcast. If you really want to nerd out, follow me on Instagram because we have thousands of people now. And we'll talk about the data in a more coherent way because we're soon starting to get into the seasonality of purchase apps. And that's what we really need to focus on so we can get an idea of where we are in 2025. Now that rates have stayed lower and now the Fed is cutting rates, different part of the ball game now than what we had in the past. Very exciting. I am so pumped. We're going to Arizona. We're going to Las Vegas. We're going to Dallas. We're going to Bergen County, New Jersey. We have tons of places to go. Denver, Chicago, everywhere. The Nerd Tour is great. I love you, New Hampshire. Wonderful time. Beautiful town.
Been to
Love
New
it.
Hampshire, yes.
Oh my God, that was
amazing.
great.
Amazing hosts. Well, thank you for being on. Interesting when you talk about the existing home sales, like, to your point, like the Fed doesn't care about them. That's not what moved anything. But the housing starts data is what made the 10-year yield pop back up. So
construction workers and GDP. That's where the action's at.
That's where the action's at. Okay. Well, thank you for explaining it all to us. We appreciate it. I will talk to you again soon.
Everyone enjoy a spread weekend. Get that peanut butter out. Get it out in jelly. Get that bread out and just thank the spreads.
Okay. We will all try to do that. All right. Thanks, Logan.